With equities plunging over the last 7 days, as havens have rallied, with an end not feeling in sight, what better time to take a look at some of the technicals, since lots of this week's huge declines appears to be technical in nature. And Abigail Doolittle, she's standing by, and I understand you have one of the street's top technicians with you.
Indeed, Romaine. And technicals really are important when you see this kind of selling action. Investors, stocks looking for support, not really finding it. There's that brutal sell-off over the last 7 days that you were mentioning. The S&P 500 headed to its worst week since 2008. So let's put this into the context of a longer-term S&P 500 chart, because the message here is pretty stark. This is a weekly chart of the S&P 500. What we're looking at in pink, the 50, or actually the 40-week moving average. In yellow, the 100-week moving average. And in blue, the 200-week moving average. And the reason we're doing this, yesterday, the S&P 500 absolutely sliced below that 200-day moving average. So you have to go weekly. But you can see on today's action, slicing below that 100-week moving average. When that has happened back in 2016 and also back in 2018, I should say, we have gone down to the 200-week moving average. That could equate to a roughly 7% drop from current levels, a 22% drop from the highs, if that 200-week moving average were to hold. This is probably a bearish message, whether it happens quickly or a little bit more slowly, as happened in 2015 and 2016, is to be told, if it happens at all. But it is a pretty strong message. So now, to talk about the other side of the equation, I'd like to bring in Paul Ciana of Bank of America. And thank you for joining us.
My
you
pleasure.
are one of the top-ranked, I actually believe the top-ranked analyst for the areas that you study: commodities, FIC, commodities, and rates. So let's take a look at another bearish chart.
Sure.
And this is another risk asset, and the technical message is probably stronger than that S&P 500 chart.
It's bleak, Abigail.
Yes, I would agree.
It is.
It's a strong chart.
This is a chart here, long-term chart of oil prices going back to the 2008 peak. And what we have here is a falling wedge pattern, we can call it, where you have two trend lines with a negative slope, where you connect the two highs here, and they've been pinged here and again here and again here. And inside these structures, it's usually 5 moves. We consider that the 4th move, or the 5th move lower here, would be down towards the low $20 a barrel mark. And now, you see what happened this month, Abigail? Oil prices slicing through?
Yes, absolutely slicing
The $50
through.
level?
Yes, I think you could easily make the case.
Trend.
Yeah, and in the near term, easily confirmed for $35. We've been showing a couple charts this week about that possibility. Now let's bring in FX, and often we look at the yen in this type of a situation, but let's actually look at where the heat is: the South Korean won versus the dollar.
It really
I should actually
is.
flip that.
There's a saying in technicals: the bigger the base, the higher in space. That's the setup that's building on the dollar Korea chart, where over the last 10 years, this is rounding out a large technical bottom. Looks similar to gold last year, where gold already broke out and had its rally. And now dollar Korea is just starting to break out above long-term trend line going back 23 years. And so it's right on the edge of a breakout that could take something like this cross upwards of 1,400 to 1,500, which would be bearish for risk.
So I know you're not supposed to talk about the what, but the what on the S&P 500 would be the U.S. corporate profit outlook. In 2008 was basically halved, so that's the kind of selling we're seeing. For oil, it would be global demand. For the won, this could suggest that the coronavirus impact in Asia could be worse, especially if we see that kind of a jump higher.
It very well could be. The other factor this week is the BOK, the Bank of Korea, decided to leave interest rates as is, which led to some temporary strength in the Korean won. If they start to pivot on that policy, like potentially the rest of the world is about to, then dollar Korea should move higher, because the interest rate on the Korean won is now lower.
And now let's finally round it out with, you've been phenomenal on rates in the 10-year yield. In about 30 seconds, talk to us about what you think is next.
So 10-year Treasury yields are in a 5-wave downtrend. 1, 2, 3, 4. The breakdown here led us to target 1.25%. We've reached that target over the last couple days. Oftentimes, this 5th wave can extend. Our next target is about 1%. The levels come in about 0.98 to 108. Could it go below that? Sure. Interestingly enough, at least maybe for the next couple weeks, we have a signal here from the RSI indicator, which is currently below 30, suggesting yields are oversold or the bond market is overbought. We also have another signal that's occurring this week right here, which you can't see right now, which actually backtests pretty well. All I'm saying is there might be a bounce in yields.
Okay.
And you should buy them.
Oh. Okay. That's a great point. So the first 3 charts, risk off this chart, risk off too, but from a haven perspective, and buy any bounce in yields. Paul Ciana of Bank of America, thank you for joining us.
Thank you.
To talk technicals in this incredible period for the financial markets.